light at the end of the tunnel now seems to be a reality. For the longest time, experts have argued that earnings recovery is round the corner and markets have not obliged. But for the first time, looks like recovery.
Hi Nikunj, good morning. Yes, you put it right. Things seem far better this time compared to last couple of quarters. Numbers are doing fine, even though they are not surprising big time, but at least they are not disappointing, which we had gone used to. What one still needs to be circumspect about is the downgrades haven't stopped. I mean, when I look at my universe, we are still downgrading 2 companies for every upgrade that we are making. So the upgrade to downgrade ratio is still 0.5. For the quarter, at least the numbers are in line. EBITDA across the board, whether it is My Universe or Nifty, it's up 22-23%, which is in line with expectations. Of course, profit, as far as Nifty is concerned, there is some disappointment because of the corporate banks where the provisions have been raised up. But I think markets will look beyond that because it is, at least as you said, signaling that we are now nearing the end of that bad asset cycle. So yes, fingers crossed, just that we are not having too much of upside room as far as valuations are concerned on Nifty, and mid caps are still trading at a 20-22% premium to large cap. So that also, in a way, in a rising bond yield environment, caps the valuation room for upside.
Yeah. Gautam, hi, morning. We can't take our eyes off from ICICI Bank. Within days, it has climbed up to 320 levels. Would you say that the worst is now behind for corporate banks, and is ICICI Bank the go-to story here? Because everything seems to be in its favor. There's clarity in the top management structure now. They seem to have washed off all the NPAs in the quarter gone by. And yeah, I mean, which is the cheapest stock available with that kind of growth vision than ICICI Bank right now?
Absolutely, Aisha. This has been our preferred pick in the corporate banking space. It's part of our model portfolio since long. And as you said, management clarity on the asset cycle, provisions have been raised further, valuations are in its favor, subsidiary valuations are also quite attractive. So I think things seems to be settling down for this name. We'll need to see a couple of more quarters whether these things are finally behind and whether we can restart the new cycle as far as asset quality is concerned. But given where valuations are, clearly the risk reward is very favorable, and for the quarter also they're doing pretty well. They've raised the provisioning estimate, so to that extent there was some miss on the bottom line front, but I think the quality of earnings has turned better. Watch list has reduced significantly. Overall stressed assets have also come off, and clearly, I mean, as I said, subsidiaries are also doing pretty okay. So it continues to be part of our model portfolio. It remains the best, pick as far as corporate banking part of the portfolio is concerned for us.
We were talking about Eicher Motors earnings coming out later today, Gautam. Do you think from the auto space it's time to now kind of step away, I dare say, from Maruti or Eicher Motors and start looking for value for that alpha play?
So actually this quarter, when I look at auto numbers across the board, there has been a disappointment, save Ashok Leyland for that matter. Maruti, Tata Motors, Bajaj Auto, Hero, the TVS Motor also. The numbers were well below expectations on the profitability front, even though volumes were in line. So clearly margin pressures are mounting, and we are in a rising commodity cost environment. So wherever there is a lack of pricing power, it will get reflected in the numbers going forward as well. We've cut earnings estimate for auto across the board, and I'm not talking about Tata Motors only. The other secular stories have also seen earnings cut. So the quarter will go down as a disappointment for auto names. What we like within the auto space for some time now has been Maruti and M&M. Our preference has clearly been towards the four-wheeler space because we feel that the competitive intensity in that space is relatively more stable, and the opportunity of volume growth continues to remain very high, be it M&M, be it Maruti. Within two-wheelers, we have liked Bajaj Auto for some time now. We feel that valuations are now reasonable, and market to an extent I think has overreacted to the fears of price war.
Gautam, this morning, we're talking about oil cooling off, and we've seen that the OMCs have reported a good set of numbers. Do you think in fits and starts, the oil and gas space, which is plagued by concerns of higher oil prices, can be seen as an opportunity? Because I saw that as a contrarian view, even when oil, it was uncertain where oil prices were headed midway through this quarter. But now that it's perhaps a more assured trade, that it's going to trend between that range of 70, 75, maybe 75, 80 at best, that one can see value in OMCs?
So clearly there is a lot of value in OMCs, whether oil is at $70 or $75. We had actually done a report talking about the value that the current market price are discounting, and there is a substantial undervaluation which exists in the space. But the problem that we need to contend with it in the next couple of months, we will be heading straight into the election cycle, and that is where a lot of uncertainty will again creep in. So while numbers can be fine, while oil prices could remain range bound, the market's propensity to ascribe the multiple to those numbers will be constrained in my view. So I think this will remain a trading bet till elections are out of the way. And even yesterday's number of both HPCL and BPCL on core GRM front has disappointed big time. The numbers which were reported were obviously propped up by the inventory gains. So I will stay sideways on OMCs.
Gautam, in the past what has worked is retail banks, retail NBFCs, consumer staples, consumer durables. At a time when markets are looking at a rotation, if ICICI Bank is making a comeback, if Axis Bank has recovered, do you think what has worked in last 3 years as a pet theme may start taking a back seat, which is HDFC Bank may start underperforming or will get into time-wise correction, HUL and Britannia may not give you any returns, Maruti may slip into a time-wise correction? Could that rotation be a very stark rotation for next 12 to 18 months?
Nikunj, there is a non-zero probability of that happening, but my view is that till the time we are out of the election cycle, what has worked for last couple of years will continue to work. And the reason is very clear. Some of this corporate banks, some of the cyclicals have done well. But as a pack, you can't take a call based on one quarter of numbers. My view is that the same 4-5 sectors, which is consumption, private banks, NBFCs, autos, and to an extent IT, will continue to do very well, at least till election related uncertainties are out of the way. While micros have clearly improved, we have seen some deterioration in macros in the last 4 or 5 months, be it on the inflation front, rate hike, bond yields, crude, the global trade war concern. So I think that will keep the market a little bit on the tenterhooks as far as the broad cyclical or the value part of the equation is concerned. The preference for us as far as we are concerned is still on the quality, with earnings visibility plays, and selectively wherever we find that things are getting better, we are increasing the weights for those stocks in our model portfolio. So like I said, for ICICI Bank, it's part of our model portfolio. We have Yes Bank as another proxy to play the same corporate banking cycle. But broadly, I will still side with the quality plus earnings visibility theme, which has worked well, and I think it will continue to work well even for the next 12 months. And consumption, as you said, has done well, and I think there you will see very strong recovery going forward as well. This has been our view for last 15 odd months, and even last 3-4 quarters, including this quarter, the commentary that has been coming in from consumers, whether it is staples or discretionary, is that things are picking up both on urban and rural. And my view is that for the next 9 months, this consumption recovery will gain further strength. So while clearly there is no debate on valuations from a 1-year point of view, but I think those valuations can remain irrational for some more time.